There we go. Welcome everyone to another live with Caeli. My name is Larry Bailey, and Caeli did awesome last week. I listened to all 50 minutes. Congratulations, Caeli, for
Thank you, Larry.
getting that done. And today we're going to be going through a very important topic. Caeli's brought it up many times before, and that, of course, is the importance of credit, separating the myths and realities. That's what we're going to be talking about. If you have any questions at all during the webinar, and next week we will be moving this back to meeting, we promise. We figured out there are so many people that are joining this every week and reserving a spot. Caeli's going to speak to this. And Caeli, we actually got a poll ready, so we're ready to get a poll when you're ready.
Okay.
But enough about me, Caeli. This is all about you. Thank you very much for joining, everybody. If you want to talk, just send me a note in chat or send me a note in Q&A. We'll get you so we can unmute yourself, so we can unmute you, and you can ask away. Caeli, thanks very much for leading us along this conversation about the importance of credit and separating the myths and realities.
Thank you, Larry Bailey. Hi, guys. Okay, so I asked Larry, if you were here when we first started, before we started recording, I asked him to hit record first so that I could make this fun announcement for all to hear, those that come back and watch later. I made the fatal mistake, you guys, of eating just before this, because I haven't eaten today, a kale salad. Okay, this happened, and guess what else? I'm out of dental floss. So, and it's my worst pet peeve, at least it's in the top 3 for sure, of just having stuff in my teeth. So you're going to be seeing me throughout the next 30-ish minutes be kind of messing around. I'm so sorry. I'm so embarrassed, but what can I do? What can I do? So for all of you that are with us today and watching later, please enjoy. Okay, and if there's like massive green things in my teeth, it's not because I've got poor hygiene, it's because I'm dental floss. Larry's going to give me such a hard time about this later. Thank you for coming. Thank you for being with us. Let's get this underway, you guys. Really quickly, Larry had mentioned that we're going to take a poll. I like the meeting format better than the webinar. The webinar, I can't see you guys. There's not that engagement, etc. But as a result, there was some, and the good news is that we're getting so much demand for you guys to want to be here with us, and the registration has gone up so much, we had to change our subscription deal thing with Zoom. My question for you guys is, how inconvenient would it be if you had to register every week for the meeting? Okay, and the reason I ask this is that if someone registers, the way that we have it now, you register once and then you're done. It doesn't have to happen again. However, what we're finding is that there are people that have chewed up a registration spot or slot that have never attended any of our meetings, that haven't listened to any of the recordings after the fact. And it's just kind of a dead spot. So I wanted to get with you guys. I certainly don't want the level of entry to be cumbersome or a pain in the you-know-what. But if you guys will tell us what you think, if registering once a week would be okay with you, that's what we're trying to figure out, and what changes we need to make as a result of that. So is registering weekly a big, massive hassle? Will it prevent you from being with us? Or is it no big deal and you'd happily do it every week? Thank you for that.
So we've got a poll running on the screen.
Okay.
And it's kind of a live thing. Everybody can kind of change their vote. I let it go in the beginning because I wanted to see what people would do off the gate, which of course is register once for all, right?
Right.
But then this idea of fairness is abound. So we'll give this, we've got out of 25 folks, looks like everybody's answered actually. So I'm gonna go ahead and end the poll.
Okay.
And share the results. You should be seeing them on screen. So,
all right.
So, you know, the reality is, yeah, it is really convenient to register once for all. The question is, how do we maintain that forever?
Okay. I gotcha. We hear you. We'll make, obviously let you guys know well in advance of any changes in that regard. But in any case, cool. Thank you guys for taking the time to do that. Kale. Okay, credit. So I'm going to start like I usually do with a few definitions. Before I get to that, I'm just going to tell you guys, I'm going to be talking kind of fast today. I want to get through quite a bit of landscape here. So I expect a lot of you will want to come back and re-listen to some of this. And much of what the teachings will be about today are actually part of our certified power buyer program that we offer free of charge, one-on-one time with yours truly. For clients that have applied and are actively pursuing real estate investing. It's a really deep dive into underwriting guidelines as they apply to the individual's qualifications, the individual's needs. taking all of that information and teaching you guys how to optimize your qualifications. Because remember, as real estate investors, our debt to income ratio, our credit, our assets, none of those things are straight lines. They are not static. They're going to move. They're going to change as we buy and we sell and we refinance and we 1031 exchange our properties. All of those qualifying variables or criteria are going to be subject to change. So understanding how does it apply when we look at you in underwriting, what does that mean as things change? And how do I teach you how to keep them at their optimal levels? So today is really going to be about credit and dispelling some of the bad information that's out there. And I'm also going to give you guys a little snippet about how to optimize credit and further some of the strategies that we impose inside that we do for our clients, and keeping an eye on these things to make sure that we are setting them up for success, not failure. We'll get there. Okay. Most individuals, guys, I'm just going to start all the way from the beginning. And if you have been through the certified power buyer, some of this is going to sound familiar, but I think it bears repeating anyway. So most individuals will come to us with 3 different credit scores. Okay. These credit scores are derived from places that we call repositories with an R. You guys are going to know them more commonly as Equifax, TransUnion, and Experian, right? Most of you listening are going to be familiar with those names. For the purpose of qualifying for mortgage-related finance, we're going to take the middle of those 3 credit scores. And by the way, if you're applying jointly with a partner or a spouse or whatever, please note that in that case, we're going to take the lower of the 2 middle. So if Mr. Jones has a 720 middle and Mrs. Jones has a 716 middle, we're taking the 716, the lower of the 2 middle credit scores. Okay, so the other things I want to share with you guys, let me go back to some of the misnomers. And I had an outline, but I don't have it with me, so I'm kind of going from memory. There's bad information out there. When people come to us, and some of the first conversations that I have, they say, well, I don't want to have my credit run. I don't want a hard inquiry. Can we do a soft inquiry? Well, absolutely, we can do soft inquiries. The reason when I do a little bit more fact finding, that I learned people don't want that hard inquiry is because they think that it's going to damage the actual score. I've heard anything from it's going to take my credit score down 5 points just for one inquiry, down to 20 points, and everything in between. That is a misnomer. That is not accurate information. The way in which an inquiry, just on its own, is going to impact a credit score is when an individual has gone out there and tried to secure credit for a multitude of reasons. So they bought a brand new motorcycle, maybe a flat screen TV, a new washer and dryer. They applied for a mortgage. They opened up a department credit score or credit card, whatever it may be. When inquiries are shown from all of those different varieties, the algorithms, the ones and the zeros within those repositories that I mentioned, what it's telling it is that that individual is about to become likely overextended, right? They're applying for all of this different credit. They're about to become overextended. That's when we notice that inquiries will have a damaging effect on an individual's credit score. And further, it's important to note that an individual, for the purpose of mortgage-related finance exclusively, has a certain window of time in which to have their credit pulled as many times as they need to shop terms and rates or whatever, without it adversely affecting the score. So please keep that in mind when you guys are thinking that somehow a hard inquiry is going to be damaging to the point that it may either preclude you from qualifying or it could adjust an interest rate. Okay, I won't get into the connection between rates and scores today. We can make that for another call, but just FYI. Okay, so let's go back to underwriting guidelines. So credit as a means of qualifying. Now, let's focus on conventional really quickly. Most people usually start by falling in that range anyway. Most of you know we've got 10 golden tickets, right? 10 Fannie Freddie loans. But what a lot of people don't realize is that of the 10, there are 2 very distinct books, I like to call them, of underwriting guidelines that, as it's applicable to credit, can change what the score requirement is. The first book of underwriting guidelines applies to the individual that has 1 through 6 finance properties. And then there's a second set or second book of guidelines that we have to subscribe to for those that are going to be in the 7 through 10. Okay. In 1 through 6, there's no hard and fast rule for credit qualification. We've got clients that have, Cael, fun for everybody. We have clients, so bad.
If you end up needing a break, we do have a question.
Okay,
But we're
let's
gonna, but
do
it's
that.
not natural. It's not natural for now, just
Okay,
unless
okay,
you.
okay. I'll keep
Okay,
going. I'll keep going.
okay.
So, so embarrassing. This is going to haunt me for years to come. I absolutely know it.
I see kale memes on our social media platforms coming up very soon.
Okay, 1 through 6, no minimum credit score required, no hard and fast rule. We have clients that might have a 650 credit score get approved for conventional financing because they have what we call compensating factors. This is going to be low debt to income ratio. When we talk about DTI, it's the lower the better, or strong assets. The more assets, liquid and even retirement accounts, the more assets we have, the better, right? So if we have both of those things, strong compensating factors, a lower credit score won't necessarily preclude the individual from qualifying. Now, I know I said I wasn't going to really get into this, but a lower credit score, keep in mind, it will affect your interest rate. A lower credit score is going to yield a higher interest rate. Don't get hung up on the interest rate, guys. For all the reasons that I continue to harp on, I'm going to move past that. 1 through 6, we've covered that. 7 through 10. There now is a hard and fast rule. You must maintain a minimum 720 or greater credit score to qualify for any of the remaining 4 golden tickets. Okay. If you came with a 719 and you were in the middle of a transaction, we closed one and you've got to close a second one and the credit report is expired, I'll tell you how long they're good for in a second, and we have to pull another one and it dropped 1 point below the 720, you are not getting a conventional mortgage. 720 minimum, absolutely no way around it. And that leads me into a good segue into the optimization of credit. So the credit report is valid for 120 days before a new report is required. These are Fannie Freddie rules. Other investors are going to have different rules about how long a report is valid before another one is required. For example, the all-in-one is a 90-day window from the day that we pull before a new one is required if it had expired. Okay, but we have 120 days conventionally to utilize the credit and the score within that credit report before we have to pull another one. So let's talk about an individual that may be purchasing multiple properties or has multiple transactions that are going on within a small-ish window of time. Let's call it they're purchasing 2 properties and maybe refinancing another one in a 4-month window of time. Okay, what could happen? Now, I've seen this happen where an individual has 800 credit scores, high credit scores, but within the acquisition of mortgage debt, and these are high ticket items, right? This is not a credit card or a car. This is mortgage debt. The algorithm, again, the ones and the zeros within the credit reporting is going to see this massive amount of debt being loaded to that individual's profile, and it could temporarily, okay, this is a temporary thing, drop a credit score below a 720 threshold. So if our example individual is kind of inching out toward that 7 through 10, maybe they're at number 5, they're closing on a 6th, and they're doing a cash out refinance on the 7th, 3 months later or something to that effect. It's kind of all mixed in within that window. It could be very devastating not to have your support team that really understands what we're looking at be looking out for your best interests. Okay, I'm going to keep my explanation going, my example going, and tell you how we can have the forethought and what the strategy would be to maintain the best results. So I pulled your credit on the 15th of February. Okay, so we've got 4 months within that time to use that credit report. All right, the credit score is optimized. There's nothing, it's perfectly high. We just closed on 2 purchases, and we have another purchase that's coming down the line after the 4-month window of time. Okay, well, I want to avoid having to re-pull that second credit report after the expiration date. At that point, these other 2 mortgages are going to hit and could have a negative impact on the individual score such that they can no longer qualify for Fannie Freddie. So I'm going to come back and say, Mr. Jones, I want to pull your credit on day 74 of that 120-day cycle. And what I've done there is I've kind of manipulated the system because I've bought us a new 120 days before that last set of mortgage debt has hit us, before there's any negative impact. So thinking about it from that perspective, we are doing another hard inquiry. Okay, big deal, whatever. But we're doing it now from a strategic perspective to buy us a new 120 days at the optimized higher credit score to ensure that we don't have any issues as we're coming up against that 720 minimum for this borrower. Because like I said a second ago, if you're under contract for something and you're kind of right on that precipice, or maybe you've got a 740 or 760, Cael, then we would have an opportunity to keep the score high before there's any negative impact and make sure that we're closing at the more optimized rates and terms that the Fannie Freddie loans would allow us. If we missed that boat or that window, or let's say you had other things going on the side that you did not communicate to Ridge and we didn't know, you'd secured other mortgages or other things that weren't disclosed during the time that we were working together, we couldn't be there to provide that insight or that strategy for you, then we're coming to try and get this done. We have to pull another report, right, at that point in time that it's expired, whatever, and it's dropped. Guess what, guys? You're either potentially losing earnest money, right? You're outside of any contingency, or we're having to switch, which I guess in overall terms, it's a benefit that we have the options to switch you into something else like a debt service coverage ratio or non-QM product, but the terms aren't going to be as favorable. So it's really, really important. I guess the takeaway in that comment would be communication with us and making sure that it's good and clear, and we know everything that's happening in between the different transactions we may be doing together. Larry, why don't we get to that question?
Yeah, great timing. So the question is from Jag. Jag wants to know, which happens a lot, right? So if somebody else runs a credit report and then they come to Ridge Lending and they're like, hey, listen, what can you guys do for us? And we say, well, we have to run your credit report. Why is that happening? Why can't one underwriter just use the same credit report for any borrower?
That's actually a good question. And to be fair, I don't know that the answer is going to satisfy anybody listening. I know, and Larry, you may be able to give a little bit more insight. The report itself, because as the lender, we are going to be underwriting and funding and then packaging and reselling, right, these mortgage-backed securities in the secondary market. The package that we are going to then deliver has to include credit that was run from our company. We will not be allowed to take an outside company's credit report and utilize that. Not to mention, if it's pulled through our system, it's all automated so that there's no manual typing in of liabilities or trade lines, right? So if we took somebody else's credit report and you had 10 different trade lines, in order to get all of that into our LOS, loan operating software system, to then figure out debt to income ratios and things and what liabilities you had and yada, yada, we'd have to manually do that. And that's not efficient and certainly not what lenders would be willing to do. So those would be the two answers that I give. Larry, did I miss anything that would be important to mention to the group here?
No, I think you nailed it. It's actually, this is a little bit deeper that most people don't talk about, but contractually, one lender cannot release a credit report to another lender. That's more about money than it is anything else. But the reality is, Caeli, I would have said the same exact thing. Everything in the file needs to be made to the lender, from credit to appraisal to title, everything. So if it has anybody else's name on that credit report, it will be unacceptable.
Yeah. I think I see another question from Jag. Yeah.
Yeah, so there's a follow-up here perhaps, and it goes along the same lines of credit myths, right? So why would one lender, perhaps, a hypothetical question here, like if I had a credit report run and one lender says no, but then you literally call up another lender and they look at the same credit report and they're like, yeah, I can do that loan. Like, what's that all?
This is one of my favorite questions because it makes us look so good. It's something called overlays, gang. So in our industry, an overlay is an added layer of risk to underwriting guidelines. So I usually stick with kind of the Fannie Freddie guidelines. There's something called a seller's guide. The seller's guide is about a 1,400-page document that, with ridiculous detail, we know exactly what conditions need to be satisfied within this loan file in order for it to be insured or purchased, insured by the United States government. Okay, so we'll focus on that. An overlay is going to be something in addition to what those guidelines say. I'll pick on, who should we pick on? B of A. Okay, historically, B of A would say, when Fannie and Freddie brought it back up to that 10 limit, B of A would say, no, I don't care that Fannie Freddie allows 10 finance properties per qualified individual. We're going to cap it at 4. That would be an overlay. Similar to credit score, for example, if that's what we're talking about, they may have their own risk tolerance overlay that says, no, we're going to cap it here. This is the minimum for us, even though Fannie and Freddie will insure beyond or whatever the AUS might say. I'm not going to get into AUS. That's probably a rabbit hole we don't need to go down, but that would be the answer. Other overlays can include experience of being an investor, right? Sometimes they want to see a 2-year history of being a real estate investor. Well, that's not necessarily a guideline for Fannie Freddie. It's not in the seller's guide. Sometimes they won't give you credit for rental income that otherwise could be per the purest form of the seller guide, and precluding your ability to qualify, right? If you can't have the income from those rental properties that have mortgages on them, and they won't give you any credit for that rental income, that's going to screw up a debt to income ratio. So that's the answer to that, Jag. Good question. Thank you for that. Any others?
That is all the questions now. For anybody just joining, we're working here with Caeli Ridge. She's going through the realities and the myths of credit. And if you have any questions, feel free to use either the chat or to use the Q&A here in the webinar.
Thank you, Larry. Let's see. So let's talk about optimization for credit. Some other tricks that I talk about regularly with my clients that you guys can just do organically on your own. And by no means, guys, I like to preface and say I'm not a credit expert. I've been around the block a few times. I know what I know. There's, I'm sure, advancements or things that maybe people on this call can teach me. I'm always interested in hearing. But just simple tricks for expanding or increasing credit scores or keeping them very, very high. No more than 4 revolving credit cards is really the cap or the max that you want to have. And of those 4, you want to keep the ones that are the oldest, right? That depth and that history of credit is important. For your purposes, clearly you want to keep the ones that have the lower interest rate, so that might not always align. But in any case, there's that. Utilization is a big one, guys. Utilization means, and this is staying on the revolving accounts, the credit cards. Other than a mortgage, and I'll come to that in a second, nothing can hurt or help a credit score more than utilization within your revolving accounts, your credit card accounts. Ideally, for optimal results, you want to have utilization at 30% or less. And I should have defined utilization. So utilization is the percentage of balance to credit limit. So if you had a $10,000 credit card limit and you had a $3,000 balance, right, you're going to be at 30% utilization. 30% and less is optimal. 50% and below is still very good. When you start inching above 50% in utilization, that's when credit scores really start to take a hit. And you get up into the 60, 70, 80, the higher from 50% up that you get in utilization, the more it's going to impact your credit score. Even if your history of on-time payments is perfect, that's really going to, somebody that would otherwise have 780, 800 credit scores, that could get them down to 700. It's a big hit. Obviously, judgments, collections, bankruptcies, things like that are going to have an impact on a credit score. Mortgages, like I said a second ago, nothing can hurt or help a credit score more or less than a mortgage. And when we were talking about some of the education about the credit score and new mortgage debt, et cetera, I didn't mention this, that typically speaking, I did say that it would be a temporary drop in a credit score, right? When we have all of this mortgage debt that we front loaded, and then we're trying to do something new, and then it sees it, and then it's going to take a credit score. What's happening there is it's loaded all of this debt, but what's not happened yet is that the on-time mortgage payments themselves, the time has not allotted enough to show that those on-time mortgage payments are reporting yet. So there's a little bit of a disconnect. So generally speaking, it's a 30 to 60-day window past the last acquisition, the last mortgage transaction or maybe purchase that you did, before we start to see those credit scores rebound back to where they started, maybe even higher as a result. Installment accounts, student loans, car payments, those things that are regular closed-ended payments, those are fine. The time that you have those, the longer the better, because it shows that you can maintain credit and make those regular on-time payments. Authorized users, be careful of this, guys. It could end up hurting you more than it's helping, depending on who you're an authorized user with, right? If you're an authorized user, I've had some times where parents will put their kids on their cards as authorized user and not really understand. They have perfect credit, they've never made any late payments, etc., not understanding that for the time in which that card itself is utilized high at 70, 80%, and their kid is going out to get credit somewhere, a mortgage, perhaps, whatever, the day in which we pull credit, that snapshot, that picture is taken. It doesn't matter that his or her father is going to pay that credit card off at the end of the month. At the time in which we're pulling credit for the youngster over here, it's going to impact their score if they're an authorized user. It's a fairly easy fix. We can have them removed as the authorized user and do a what if scenario and make sure that that'll bring the score back up. So there's lots of things that we can help in that way, but that would be something else. Why don't we go back to questions now, Lair?
Yeah, we've got a ton. You really did a great job on getting questions out of folks. I want to take a couple of these and put them together because the question from Alexander and Jag, although different questions, do talk about things similarly, which is if you have something on a credit report and it is just there for the moment when the credit report runs, but maybe is soon paid off down to zero afterwards, how does that affect utilization? How does it affect credit score? What's your vibe on that?
That's another really good question, you guys. So what you need to find out is when does the creditor report that information, the data tape, to the repositories? Okay, so if you charged up $8,000 on a $10,000 limit card and then paid it off the next day, the day in which you charged it may still be reporting by the time I pull credit a week and a half later. So if that's the case, you're going to want to have the communication with us that says, well, first of all, what you're going to need to do is call the creditor and say, Amex, what day or days of the month do you report this information to the repositories? If we have that information, then we can time it appropriately to pull credit on the day that we know we're going to have that lower or paid off balance, and ensure the highest credit score possible. That said, guys, don't get too wound up in this, because if you have an 800 credit score and you have and there's a little something different than an Amex, the open structure Amex, that shouldn't actually hurt your score. There really shouldn't be any impact because it's structured so that it knows it's paying off at the end of the month. So in that case, I wouldn't worry about those. But anything else that's just open-ended revolving, that balance can continue to grow or shrink or whatever, that's when that utilization thing is going to have a play.
Yeah, and that leads us into Edwin. Edwin asked, well, what if you have a home equity line of credit and you've maxed it out because you're doing something with it? Have you seen that negatively impact the credit score?
As long as it's reporting as it should be as a mortgage, okay, it can say HELOC, but as long as it says mortgage, a maxed out HELOC should not adversely, and I think that they're all set up now, guys, so that it does report that way. There was a time, I don't even know how long ago it was, but there was a time where a HELOC would just be reporting as revolving and it wouldn't necessarily identify itself as a mortgage, in which case, yes, I did see that utilization could damage a credit score. But anymore, I think that what's the abbreviation, Larry, for who oversees credit? I'm totally spacing.
CFPB.
Thank you, CFPB. So the CFPB, I think that over the years has come up with ways in which they can protect the consumer, which is top of mind, right? That's their the reason that they even are a thing. So it as long as it says mortgage, and I haven't seen one in many years that doesn't attach itself as a HELOC mortgage, it should not impact your score now.
Just following up on that, Jag asked a follow-up question, and Alex, we're going to get to your question next. But so Jag asked, what about home improvement loans? And naturally, you're talking about, Caeli, the difference between a revolving or some type of line of credit versus a fixed home improvement loan.
Yeah, great questions, Jag. Thank you. The home improvement loan will be a fixed closed-ended loan, in which case it's just going to show up as a mortgage. So as utilization goes, it's not going to negatively impact a score.
And Alex just wants to round us up where does the 30% utilization rule apply only to revolving, like credit cards, or is it the average of all of your liabilities?
It's just going to be the revolving. It's not going to include the utilization, or it's not going to include an installment loan or a mortgage loan. It's just those open-ended revolving accounts. Different than an Amex open 30-day account, if you guys know what that is. For those of you that know what that is, that's mandated. You have to pay off whatever the balance is at the end of the month, in which case it does not fall within the utilization revolving algorithm for credit scoring.
It's been a while, Caeli, since I've seen one of these, but back in the day when we got our first credit, stores would have like a 30-day charge account,
Mm,
which is kind of the Amex model. I don't even know if that still exists. Do you come across that at all, where it's a 30-day
I
charge?
I don't think so. No, I probably no, I'm gonna say no. I can't recall the last time I saw something like that.
And if somebody wanted to get a copy of their credit report, what are their options, especially with scores?
Yeah, so obviously, guys, there's all kinds of online stuff that you can get. I would comment that what you're pulling online through a Credit Karma or whatever the other ones are, is not necessarily going to be the same as what we pull on our end. We pull what's called a tri-merge. Um, and I find regularly, I don't know if I would give it a percentage, but regularly I find that our scores end up being a little bit higher than what you guys pull on your end. Maybe if it's even just a couple of points. So you can do all this stuff online and get the free stuff. It may not be give you the same result that we would have. And it certainly is not going to be as easy to read as a mortgage credit report. The ones that people will send me to say, hey, can you take a look at this? Which nowadays I just say, no, I got to pull it. I'm not going to look at what you have online because they're like 50 pages and there's just so much information in there that you don't need. Otherwise, I would tell you to get with us, apply, we'll run your credit report. If you insist after everything that you've heard here today on the soft pull, we have the capability to do that. So we can check that out for you. Otherwise, yeah, those would be the two obvious ways that you could get a copy.
This is just to align with, the facts from the myths you've gone over. Is there anything that you want to leave the group with today in terms of what should be the biggest takeaway that you think most people think is real, but is actually just a myth?
Honestly, it's the inquiry thing. People get really hung up on that inquiry, and that if you have a hard inquiry, that somehow it's really going to damage the score by some great number, and that's just not the case.
If anyone has any final questions here before we close out for the day, again, feel free to use the chat or even raise your hand in the Zoom part there, and I can click the blue button that says allow to talk, or throw an open question. And thanks again for those that participated in our survey at the beginning of the show. We want to make sure that we make it as convenient as possible, but making sure that nobody gets boxed out from registering for these as well. Looks like Jag is going to throw one more at you, Caeli. You ready?
I'm ready.
Here it
Bring
comes.
it, Jag.
At what stage should we come to you, Caeli, for the investor look over program? He means the certified power buyer, of course.
Immediately. If you're Kale, God, how embarrassing. If you think you're going to be purchasing or refinancing something in the next week, month, even the next year, it probably isn't a bad idea to get on board with that now, because there's so much good information, you guys. Today's was more of an abbreviated version of what really goes into the credit side of the certified power buyer. Those of you that want to learn and have that look under the hood, I don't think that any delay is appropriate. And in fact, more often than not, especially if you're just getting started, there could be things that we discover inside the certified power buyer review of your application initial documents that you weren't aware of, right? That needs some massaging or some hand holding to get, optimized if it improved your rate or your ability to qualify for more or the all-in-one or some other product or what have you. So I would say that delaying is not to anyone's advantage necessarily.
Two last questions here. So Leah asked, just for a little clarification, Caeli, for the 30% utilization, is it of the total credit balance, or is it also including each credit card or each credit line of credit, that kind of a thing?
So it'll be a weighted average, I think, Leah, but they're going to look at the individual trade line. So your Chase card or your B of A card or your Capital One or your Citi card, whatever, they're going to look at each one individually, but there is going to be an overall revolving debt utilization. It'll take all of the limits and all of the balances added together, and that will play a role too. That's probably more impactful than the individual, is probably the overall sum of the revolving accounts balances versus limits.
Gotcha. And Katie, Lawrence, I see your point there. We'll make sure that you've been helped appropriately. Caeli, we just want to follow up with Katie for the certified power buyer, okay?
You bet.
And so, Katie, thanks very much for bringing that to our attention. And then last one here for the day, it looks like. And if you have any questions, of course, following this, you're listening to this on the community, feel free to use the chat in community or give Ridge Lending a call directly, honestly. And that's 855-74-RIDGE, or you can email to info@ridgelendinggroup.com anytime about any of this stuff. So James wants to know the great question of pre-approval, right? James is thinking about buying a house. It's not really decided on it yet, but he wants to know what's going on. What would the inquiry, how would the inquiry harm the score? What should James do, Caeli?
James, no, an inquiry, sir, is not going to be the deciding factor on whether you can qualify or not. I can almost guarantee it, except for under the precipice that I started by explaining. If you've had your credit pulled, hard credit inquiries pulled by a variety of different creditors, mortgage, department store, new credit card, a flat screen TV, a new car, all of those different things, that's when multiple inquiries are going to harm you in a way that it could damage your ability to qualify. Otherwise, sir, I would say no, there really shouldn't be anything. And the other thing, you guys, real quickly, if you have an 800 credit score, if you start with an 800 credit score, and let's just say that you did take a 20 point hit, and now you're at 780, guess how that impacts your qualification or the rate that you have access to? Zero. There's zero impact whatsoever. 760 and above tends to be the threshold for optimizing an interest rate. But I guess we'll talk about interest rates again. The difference in rate and or payment between a 760 and say a 740 is negligible. Maybe if it's anything, it's 1/8 of a percentage point. And 1/8 of a percentage point on 100,000 or 200,000 is what, $6 a month? So credit's important. We want to keep it good, but I feel like similar to interest rates, there's a psychology attached to a credit score that a lot of people get tied up in. Anyway, I would say apply now, James. Let's pull your credit. Let's look at it and let's start creating our roadmap together, planting those seeds, man.
And Caeli, I sent you the link for Katie's information so we can make sure we take care of it.
Got it.
Ron says, Caeli, you rock. Thank you to you and your team for sharing your knowledge and expertise with us.
Thanks, Ron.
Caeli, we're going to do this in a meeting next week. We're going to get this thing worked out. We got the floodgates open, and we're going to work with our Zoom folks over there to make sure this is done. Any final words?
I will not be eating kale tomorrow, 5 minutes before or not tomorrow, next week, 5 minutes before our 1:30 meeting. Thank you guys for putting up with that. That was horrible. My worst nightmare.
And so many memes to come.
I can't wait, Larry. I can't wait. All right, guys, thanks for being here. I'll see you next week. I'm gonna go find some dental floss. Peace.